Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is September 25th, 2009, and my guest is Gary Stern, who just recently stepped down from being president of the Minneapolis Federal Reserve Bank. He is the author with Ron Feldman of the book Too Big to Fail, The Hazards of Bank Bailouts. Gary, welcome to EconTalk.
Thank you. Good to be with you.
Your book, Too Big to Fail, which is the subject of our conversation, it changed my life. I don't say that too often about books here on EconTalk. Occasionally. I was in the Stanford bookstore a few months ago, and somehow, even though they have a very large selection of economics books, and they only had one copy of yours, and it was just the spine showing. It wasn't face out, as they say in the business. But the title was big print, and it caught my eye, and I thought, well, Too Big to Fail. I need to know more about that. I picked it up. I didn't know much about the history of bank bailouts, and I saw that it was written, I think, in 2004. And figured, well, that was a while back. It's probably not so relevant. But I leafed through it, and I thought, I need to understand this. So I bought it. And it really helped me understand what I consider the fundamental questions of the financial crisis. And listeners have heard me ask about this many times. Why would a firm like Bear Stearns or Lehman Brothers or Fannie Mae take so much risk? Why would they be so leveraged? Why would they put themselves in a position where a bad quarter would kill their firm? Why weren't there more natural forces of prudence to restrain them? Yes, there had been bailouts in the past, I thought to myself, but they were always partial bailouts. They always punished equity holders, and I thought, punishing equity holders, that should induce some prudence. But what your book showed me was that punishing equity holders while bailing out creditors and bondholders and other counterparties has some subtle incentives that are not so obvious. And to understand those incentives, I'd like you to start with the modern history of bank bailouts in the last 25 years. What has happened and what form have they taken?
Well, of course, if you go back 25 years, you go back to Continental Illinois, which is sort of the forefather of this, at least in modern times. Continental Illinois at the time was a very highly regarded commercial bank and a significant large one as well. When it failed, due largely, as I recall, to energy-related exposures throughout the country, the creditors of Continental Illinois, large and small, and in fact in their case went beyond the creditors, were protected by the federal government. And the reason for that protection, so they didn't suffer any losses, the reason for that protection was policymakers' concerns about spillovers or contagion effects, which just means that the concern was that problems at Continental would adversely affect other large financial institutions, important financial markets, and ultimately the performance of the economy itself in terms of output and employment and so forth, that there would be significant negative consequences. And so the decision was made to try to limit the damage, limit the spillovers, and therefore avoid the adverse consequences that would follow.
They were the eighth largest bank in the United States at the time, I think.
Seventh largest or something like that.
So they were big. I mean, the irony, of course, is that most people listening have never heard of them.
That's right.
Because they're gone. So this is some obscure event.
Pardon me?
It sounds like some obscure event. Some bank was bailed out, but it was a very large bank. And right. I think you said they had something like 5,000 counterparties. So the worry was they were so connected with all these other creditors and borrowers and lenders that it would make a mess.
Exactly. And among their creditors, they had borrowed a lot of money from community banks around the country. And in some cases, the community banks had exposure to Continental well in excess of their capital. So that, if Continental were allowed to fail, there would no doubt have been cascading into a wide range of other financial institutions, including a host of community banks. But that wasn't the only problem. But that was part of it. So Continental Illinois was, as I say, the forefather of this. And in fact, in congressional testimony following the Continental Illinois episode, the controller of the currency at the time indicated that there was something like 11 banks in the country that he considered too big to fail. And of course, that sent a pretty strong signal to the creditors of those institutions, at least, that they were not going to be exposed to losses no matter how big the risks that the institutions in which they were creditors, no matter how large those risks were taken.
Now, the technical name for that is moral hazard. That's what the economists call it. It's a really ugly phrase. Doesn't convey anything about what it really is. It's a simple idea, which is, as you say, that the normal forces of prudence for a creditor is to make sure that the institution that you're lending to doesn't go bankrupt. It's all you care about. You just want them to stay in the black, and so they can repay you for the loan you made.
Exactly, because creditors, unlike equity holders, creditors don't get any upside. If you make a loan to a bank or whomever, you're going to collect your interest payments over time and expect to get your principal back at the end of the day. No matter how well the institution does, you won't do any better than that. Equity holders are making a whole different. That's a whole different kind of transaction. And so imposing losses on equity holders it doesn't do any good in terms of dealing with moral hazard.
That seems
they get
counterintuitive. That seems counterintuitive, right? They don't want to lose their equity. Why would they want to lose all their money?
Well, I think part of the answer there depends on how diversified the equity holder is. And for example, if you are a large institutional investor owning equity in lots of different companies around the country and perhaps around the globe, you don't have large exposures to anybody. So even if somebody goes bankrupt, that doesn't have a big effect on your performance. I would contrast that to a community bank that, say, is family owned, and the family has a lot of their personal wealth tied up in the equity of the bank. Well, they have lots of incentives to be prudent. But you can't say the same thing about the equity holders of large institutions where the equity is broadly held across the world in very small proportions by every institution.
Yeah, this was a deep insight for me because in my mind, and I think in a lot of people's minds, you have the bondholders, creditors, and the equity holders. And you tend to think of the equity holders as a group standing off on the side, watching what the firm's doing, saying, hey, now don't be too risky. But there's no such group. There's no group that's sitting there with all their wealth in that one stock. That would be extremely stupid. There might be some people foolish enough and reckless enough and naive enough to invest their entire wealth in one stock. But when we say the equity holders, it makes it sound like they have a particular interest. But of course, they're diversified, as you point out.
Right.
And a high-risk stock adds a little zest to their portfolio because it might not go broke.
Well, exactly, and it's a risk and return thing. They know that you don't get any above normal returns without above normal risks. I think they hope that in sufficiently diversifying their portfolios, they can diversify some of that risk away, and perhaps some good professional investors do in fact do that.
And of course,
to the extent that they do that, they certainly don't exert any discipline on the management of the institutions we're discussing.
Now, the management themselves are stockholders.
Right.
Often, not always, but often they are. They have an equity stake as well, and surely they don't want to be wiped out.
Well, that's correct, and that's something that I've been thinking about for quite some time, and I think that's where we get back to the moral hazard issue. I don't think that the management or large shareholders of some of the institutions that got into serious difficulty were excessively greedy or greedier than management in the past or anything like that. I think they were responding to the incentives they confronted. And one way of thinking about that is if creditors expect to be protected, then they have no incentive to worry about the risks the institution is taking, which is just another way of saying that risk-taking is mispriced. It's priced too low. And we know that when something is priced too low, too much of it will be taken on. And I think that's what happened in some of the very high-profile cases over the last couple of years. Now, obviously, some large institutions avoided the problems. at least avoided them to the extent that they didn't either go out of business or require bailouts or so forth. But, of course, they did suffer substantial declines in equity values, at least for a time.
In the short run.
But that's where I think the mispricing of risk matters. And it's also true, of course, some managements are better than others. And so some firms manage to avoid the worst of this, even though their creditors may have believed that they would be protected.
Well, the other factor, and I learned this from a conversation with Paul Romer, the other factor, of course, is the salary. So their downside risk, it's true they don't want their equity to be wiped out, but they usually can't cash in their equity. So when they lose, in the case of the recent calamity, hundreds of millions of dollars in stock value and equity value as their stocks fell, they were comforted by the fact that, one, they couldn't have cashed that out when they were high, and secondly, they made very, very large sums of money in salary along the way. And they did sell some of their stock in the good times. So many of them are worth hundreds of millions of dollars, despite the fact that their stocks went down.
Yeah, and presumably the smart ones, even where they owned a lot of company stock, diversified the rest of their assets away.
Exactly.
So they whatever losses they suffered, it wasn't on their entire portfolio.
Yeah, they were making $10, $20 million a year, and they weren't in cash, and they weren't using that to buy up their own stock. They're using it to buy other stuff that was, of course, safer, because they're not stupid.
Right.
Contrary to what the standard view that they were just so greedy they couldn't stop and dancing while the music was playing. They were prudent with their own money.
Well, and I think it strains credibility to somehow believe that people are more greedy in the first decade of the 21st century than they were 10 or 20 or 30 or 40 years ago.
Yeah, it's a strange view of human nature.
Right.
But let's go back to the history. I want to get us to the present with a little bit more of the past. So Continental Illinois, all of their creditors and bondholders are avoid any costs directly. Of course, the bonds go down, I assume, in the interim period when there's uncertainty about what's going to happen. But once the bailout is announced, the bonds return their full amount face value to those who hold on to them.
Exactly.
And they had equity holders, right?
Yep.
And they were wiped out.
That's
close.
Close to wiped out.
Yeah.
I don't think they were entirely wiped out in the Continental case.
Because in some of these, but they weren't. They weren't coddled by the government in any form. Is a better way to say it.
Right.
So that was 1884. It was a long time ago. It was one event. You do have the testimony you mentioned, where the head of the Office of the Comptroller of the Currency makes the imprudent remark that, well, actually, it's not just this one. We'd bail out all the top 11.
Right.
And what happens going forward that reinforces or not that belief that large financial institutions will be taken care of in the creditor-debtor side?
Well, I think one of the things that happened, although it's not something that we emphasized in the book, and I don't think it has been emphasized, but I think there was another banking crisis in sort of the late 80s, early 1990s, and a lot of savings and loans institutions failed, and a lot of people lost money.
Yep.
But there was also episodes of forbearance where some large financial institutions, had you marked their balance sheets to market, would have been seen to be insolvent. But that wasn't done. In fact, they were given time to recover, which in fact they did. But I'm sure that creditors are pretty sophisticated people, and I'm sure creditors understood what was going on during that episode. So I think that probably served to reinforce served to reinforce the notion that if you were a creditor of a systemically important financial institution, however you care to define that term, if you were a creditor of such an institution, you were likely to be protected either directly or indirectly if the institution got into significant difficulty. The next high-profile episode was really long-term capital management, which was a different kind of fish altogether, but I think creditors drew the same conclusion.
So let's talk about that. Before we do, though, during this period between the long-term capital management happened in 1998. In that 14-year period before that, you point out in the book, many banks went broke.
Mm-hmm.
And the FDIC covered many, almost every dollar of depositors' money, even when it exceeded the limits the FDIC had promised to guarantee.
Exactly.
Which, of course, go ahead.
Well, I was going to say, I mean, that changed with the legislation passed in 1991, I believe, called fiducia, when and there's two things significant about fiducia, at least. First of all, the government had to engage in least cost resolution of bank in terms of resolving banks that became insolvent or were close to becoming insolvent.
What does that mean?
And the idea behind that was to, in fact, impose losses on creditors. And if you look at the history of resolution of bank problems following fiducia until the recent episode, and putting long-term capital aside, I think you'd see that the FDIC did in fact pursue that policy. Having said that, there was also in fiducia an out that basically, and by the way, that an out that I think deserved to be there, that basically said to the regulators, you could avoid least cost resolution if you thought there would be significant systemic adverse consequences from pursuing that policy with regard to a particular institution. So there was an out. Now, I think a lot of people thought that fiducia dealt with the too big to fail problem. I think it wasn't unanimous, but I think there was a pretty widespread conviction that because of least cost resolution and some other things in fiducia, it dealt with too big to fail. My co-author and I, Ron Feldman and I, didn't reach that conclusion at all. We thought, in fact, that fiducia did not effectively address too big to fail, and for better or for worse,
because
we
of that
turned
loophole.
out to be right.
Because of that loophole.
Well, yes, because of the loopholes, and because the loophole was simply mirrored, actually, what happened in the Continental Illinois case. Part of the loophole is you've got to have agreement among the FDIC, the Board of Governors of the Federal Reserve, and the President and Secretary of Treasury that you're not going to pursue least cost resolution. Well, all of those are the people who were exactly involved in the decision to bail out the creditors of Continental Illinois. So, while some people thought that escape clause in fiducia was very unlikely to ever be invoked, we thought, heck, they were just formalizing what was past practice.
But you do point out just now that in the interim there were some prices paid by creditors for bad decisions in this period.
Right.
What about? And it's interesting to me. You don't mention the savings and loan, and you don't mention any of the Mexican crisis or the any of the other international crises before 1998.
Right.
Is there some role that they played in the perception of creditors?
I think the key observation is the one I made earlier about forbearance. I don't think the savings and loan situation or the foreign debt crises had any significant separate effects. I do think that you and I have both commented now that some creditors, in the wake of fiducia, some creditors did lose money. Losses were imposed on them in the week. Those were all creditors of relatively small financial institutions, and that's obviously a very significant distinction. That is, fiducia was really never tested until the recent episode. Now, that's good news and bad news, of course. We had a pretty long period of financial stability, all things considered, and that's the good news. The bad news is, when tested, it was found wanting.
It wasn't used, and I'm sorry to report that when I interviewed Alan Meltzer about this some months back, I asked Alan why we didn't use fiducia in the current crisis, and he said, "Well, I told Hank Paulson to use it." And I said, "What did Paulson say?" And he said, "Well, I asked the banks, and they were against it." Well, they would be, because it removes their management.
That answer was predictable.
Yeah, it removes their management, so of course they were against it.
Yeah, no, I think, but I think more fundamentally, people should not have kidded themselves about the prospective effectiveness of fiducia. And without, I don't want to get too far ahead of the story here, but I think it's important to make the point that a big part of our book is you have to prepare for these crises or disruptions or whatever you want to call them. You have to prepare for them well in advance. When you're in the middle of the crisis, to sort of say, well, let's invoke fiducia, I mean, that's virtually meaningless. Part of this is about preparation, and I'm not suggesting preparation is necessarily easy or without or free or anything like that, but it's essential.
Well, I want to come in the last part of our conversation. I want to turn to ways we might improve that. So we'll get to that. Let's go back to long-term capital management in 1998. So they were a hedge fund, and we talked about them recently in conversation with William Cohen, the author of House of Cards. They were a hedge fund, not a bank, not FDIC insured, not SIPC insured. They were just a hedge fund that was highly leveraged, meaning they had borrowed a lot of the money they used to make their bets with.
Yeah. Well, I think the long-term capital management is, there's different ways of reading that situation, of course, because no government money was explicitly put in. At most, the Federal Reserve Bank of New York sort of convened a group of large Wall Street counterparties, and persuaded them to, put in enough funds, and so that long-term capital management's positions could be unwound in an orderly way. And I think the concern with long-term capital management was twofold. First of all, they did have exposures around the world to lots and lots of counterparties. So had they been unable to honor their commitments, it would have had a global implications of unknown magnitude, but global implications because there were so many counterparties involved. And there was also concerns about fire sales of assets, which is in a way a very similar concern. That is, if because of their leverage, long-term capital management had to liquidate its positions in very short order, that would put a lot of downward pressure on asset prices, and that other owners of those assets would experience capital losses, which would impair their conditions, and so on and so forth.
Can I just interrupt that for 1 second? Because that argument is used a lot in the I'm sure it was invoked then, and it's used now to talk about why mark-to-market is, quote, part of the problem. Mm-hmm. The problem with that argument, it seems to me, so let me just make sure I understand it correctly. The argument is that if they sell quickly, firms that hold similar assets will have to reprice them on their books. Their capital cushion then will no longer meet requirements. They'll have to start unwinding their positions, and you've got this horrible cascade, right? That's the claim.
That's the story.
But the problem with it is that it gets too much mileage out of the quickly part. It sort of says, well, but if they have to sell them quickly, well, let's say they had to sell them slowly. The real problem isn't the speed at which they have to sell them. It's that the assets aren't worth very much. Now, it's true that, some markets for some assets are thin, but the real problem is that what they were holding actually wasn't worth nearly as much as they had thought. And
I agree with you. I'm an advocate of mark-to-market accounting, and I think if mark-to-market accounting were pursued in a consistent way over time, it would clearly be helpful rather than detrimental to financial stability. So you're not going to get any counter argument from me on that, Russ. I'm simply describing the thinking behind some of this.
Go ahead.
Yeah. So that was the long-term capital management thing. But if you take a step back and you ask yourself, what's the reaction of creditors to the way that was resolved, I would say it once again reinforced expectations of too big to fail coverage.
And even though there was no government money, the fact that the government, when they called that meeting, it wasn't so voluntary. It wasn't like they were just a friendly matchmaker. They basically coerced those firms in the sense that to make them unhappy would have been costly. And of course, Bear Stearns was the only Wall Street firm that refused to go along with that. And they paid a reputational price with their counterparties and resentment.
Right.
Okay, so that was 98. What's the next thing you think is important in the reputational effects of the expectational effects, of creditors?
Well, I think if you think about the episode between 1998 the early 1990s and the recent financial crisis, for the most part, that was a period of tranquility in financial markets, for the most part. So I would say that, aside from the issues we've discussed, I can't off the top of my head, but maybe you can, think of other episodes.
I think there are two.
Okay.
Correct me if I'm wrong.
Yeah.
One was 1991 when Drexel Burnham went out of business. And the
government, sure, but I was sort of moving on beyond that. And Drexel,
but the government let him go.
Yep, they let him go, and they wound him down in an orderly way. That's right.
And maybe we'll talk about that later. I have my own sinister theory of why that they were one of the few that was left to die. But let's put that to the side. But I made a reference, and I don't know much about this. Maybe you know more than I do, to the so-called Tequila Crisis in the early 90s, that when Mexico had problems, a lot of banks had lent them money.
Yeah.
And my understanding is that the federal government was very eager not to see, the U.S. government was very eager not to see those bills go unpaid. Am I incorrect about that?
You mean the Mexicans' obligations to the U.S. banks?
Correct.
Yeah. No, I think you're right. I don't remember the ins and outs of that episode to offer a lot of commentary.
I don't either. So let's.
I commented about forbearance earlier, and it wouldn't surprise me that some of those international exposures were part of the reason that forbearance was practiced in the case of at least a handful of large institutions.
When you say forbearance, what do you mean? Explain that again.
Well, forbearance is when you look at a financial institution and you value its assets relative to its liabilities, and if you're rigorous enough about it, you might find out that the institution is insolvent. On the other hand, in which case you'd have to deal with it, or you might at the minimum say they've got to raise more capital. Forbearance is when you're more generous in how you do the evaluations, which is effectively giving the institution time to repair the damage and grow or find some other means out of the situation.
And I think what you were saying before, it's a subtle argument, right? You're saying that creditors, when they saw the government not enforcing those capital standards or mark-to-market as rigorously as they normally would, saw that the government was trying to help them avoid.
Yes. And and creditors are a very sophisticated group. So, they at least some of that population of creditors would recognize that forbearance was going on.
Sure.
And in fact, some of them no doubt were counting on it when they initiated their exposure to some of these organizations.
Sure. Now, one puzzle about this claim, and I'm sympathetic to it, but let me challenge it. Besides the example of Drexel, which it's one example, but it's a big example. Mm-hmm. The other question would be, if the claim is that because of the reduced risk to creditors that these institutions became more risky, it's a bit of a puzzle as to why it took so long for it to blow up. You know what I'm saying?
Yes. Oh, sure. I know what you're saying.
I have an idea, but I'd like to hear yours.
Well, I wish I had an answer to that question. I think getting the timing of these kinds of things, or putting it the other way around, trying to predict in advance what's going to set off a financial crisis is virtually impossible. Now, I know that there are some people who claim that, they recognize that residential real estate was overvalued and that the subprime lending was a problem, and that some households were in way over their heads, and so forth. And there's no doubt about that. But calling a financial crisis with anything like accurate timing, that it was going to begin in August of 2007 as opposed to August of 2005 or August of 2011. I'm not aware of anybody who really got all of that right. And even if they did, I'm not sure they could repeat the performance. I mean, I think that is an absolutely daunting challenge.
But I guess, part of it is, the way I think about it is that, an institution like Fannie Mae, was inherently unstable. It was dysfunctionally.
Well, that's certainly true.
It was dysfunctionally designed in that there was an impression. This is the most extreme example of what we're talking about. It wasn't written into law, but it was as close as you could get, that creditors and lenders and bond buyers and securities buyers of Fannie Mae and Freddie Mac stuff believed, correctly as it turned out, that the government would bail them out. And everybody understood, economists and observers, that created a very unhealthy set of incentives for Fannie Mae, and that's why they had their own regulator. But it takes a while for that regulation process to get corrupted. And although you couldn't have said when it would get corrupted, it was not unreasonable to suggest that this was an unstable situation that would eventually blow up. And of course, it did.
Well, no, that's exactly right. And in fact, lots of regulators from lots of organizations testified before Congress about the inherent instability, as you put it, of Fannie Mae and Freddie Mac. It was widely recognized with regard to those two institutions, but there was obviously no strong desire to do anything about it.
Yeah, well, that's a longer story, but
right.
Let's move on to the present. And before we do that, I want to ask you one more question about the incentives, because I think this is a key point that I'm just realizing, and I want to see if you think I'm right. If I am leveraged, that is, let's say I have a 2-to-1 ratio between my investments and my capital. So half of what I have invested is, say, assets of my own. The other half is borrowed.
Right.
Now, in that situation, which is a very, very, very low level of leverage, 2-to-1,
right.
I have this huge cushion that if things go south on my investments, I've got my own, these assets, or half of what I've got, they don't have to fall very far. If they fall very far, I'm still going to be able to compensate my borrowers. So my borrowers feel very good when they see, my lenders. My lenders and creditors feel very good when they see I've got this big capital cushion of 50% of my investments to compensate them in case those investments turn out to not do so well. That's 2-to-1. Now, my claim is, and I want your reaction, my claim is that if I live in a world of too big to fail, if I think and if my creditors believe that I am likely, not guaranteed, but likely to be bailed out, and of course, it's all about likelihood because the future is uncertain both in the government policy and in my returns. I'm not trying to destroy my company. I don't know for sure how my risky investments will turn out. So if I'm at the 50-50 and I'm living in a world of too big to fail, don't I have a natural incentive to increase that leverage as much as possible and bet littler and littler of my assets and more of other people's money? Because those other people, one, they're comfortable because they think I'm probably going to bail them out. I might have to pay them a little bit more higher rate of interest, but they're comfortable, and I'm going to increase my rate of return on my asset base higher and higher and encourage the riskier and riskier bets. Is that true?
I wouldn't disagree with that description in any serious way, but I think the only thing I would do is I would emphasize a little bit more than you did the incentives or motivations of the creditors. That is, recognizing that they are going to be covered by the taxpayer, if not by the equity of the firm they're exposed to. Recognizing that's where the mispricing of risk comes in. That is, they are willing to lend money to this organization to permit them to leverage up at lower rates than otherwise would be the case, and so more leverage occurs than would otherwise be the case. It's a lack of a market discipline that's a part of in a very critical part of this story. And it comes about because of creditors' expectations. And so, as long as those expectations are what they are, this problem is going to persist. And of course, as lots of people have observed, one of the outcomes of the last couple of years, although obviously the jury is still out, we haven't seen all the resolution of everything. But one of the outcomes of the last couple of years is probably to more deeply embed expectations of
sure.
Creditor protection.
Yeah, absolutely. The reason I think about that issue of what would a firm's optimal level of leverage be in the face of too big to fail is that it's puzzling why a firm would put, as in the case of Bear Stearns or Lehman, their leverage 33 to 1, 40 to 1, 50 to 1, meaning they're putting in $1 or $2 of their own assets for every $100 that you're gambling. And when you do that, one, you put the existence of the firm at risk because a small change in asset value wipes you out, which is a bit puzzling. So what are they getting in return? Well, it seems to me what they're getting in return is the opportunity to make much larger bets, right? Because they're borrowing so much money on top of their assets. And of course, they're going to take riskier bets as well.
I think from the point of view of some of these firms, they could borrow relatively cheaply. They saw what they perceived to be investment opportunities of one type or another that, no doubt had some risk associated with them. But given how inexpensively they could borrow, they obviously believed they were going to be more than adequately compensated for the risk they were taking by the prospective returns on the assets they were acquiring. That's got to be the nature of the calculation they were making, and obviously in several cases it came a crapper.
And in several cases it didn't.
The ex post result is frequently different from the ex ante expectation.
Yeah, but it's also easy to forget that a lot of them did fine. As you said earlier, they survived it. They got their cake and ate it too.
Right.
Their stock didn't go to zero. They ended up having a big return as their competitors were destroyed, and along the way they made a lot of money. The worst part of your story, when you said, and it really resonates when you say, they could borrow at low rates of interest. Well, the question is why? How can you borrow at a relatively low rate of interest when you're putting those lenders at such risk, knowing that they're in a world where a small change in asset values could destroy your company and therefore wipe out their loan? And of course, the standard answer is, well, they just expected housing prices to keep going up. But the alternative answer is they were lending to each other. So their likelihood of being bailed out was even higher than if just, it was the Chinese lending to Fannie Mae.
Well, and except for in the case of Lehman Brothers, their bets turned out to be right.
Yeah,
they were protected.
So let's talk about let's talk about Lehman Brothers. So why do you think they were left to twist in the wind and were not bailed out?
Well, I wasn't. Let me be clear. I don't want to overstate my expertise or knowledge here. I wasn't on the spot in New York or Washington when those decisions were being made. My, officials have said that there was no effective means, because this was before the passage of the TARP legislation and so forth. There was no effective means to deal with Lehman Brothers. There were, reportedly anyway, a couple of potential private sector acquirers who backed away, and that may be testimony to the fact that senior management at Lehman simply misjudged the situation and was essentially asking too much. So that may be part of the story. But I must admit, I'm viewing this from roughly 1,000 miles away, not being on the scene. And it may have also been a view, and I don't have firsthand knowledge of this, that in the wake of all in the wake of Bear Stearns and all that had gone on in the ensuing 6 months, that there was a view that Lehman Brothers creditors had ample opportunity to adjust their exposures if they were sufficiently concerned, and if they didn't. That's too bad, and they should bear some losses. As it turns out, obviously people have used Lehman Brothers as kind of a marker for the real onset of the deepening financial crisis and so forth. I think maybe Lehman gets a little too much blame there, frankly, and AIG not enough.
I agree.
Because AIG was a AAA rated institution with exposures around the world, with no effective comprehensive supervision, And it really did come out of the blue. And I think what really shocked people, or at least I'll speak for myself, what really shocked me is I didn't know a lot about AIG, but I did know that they were big, and I knew there would be lots of trouble if AIG were permitted to fail.
Yeah, well, I think there was a lot of other stuff going on, and it's just convenient, I think, for some folks to blame the failure to bail out Lehman as the onset of the crisis.
Right, I agree with that.
Because I think the most consistent with your story, and I'm writing about this now in an essay, and I'll share it with you when I get to this, but when I get it done. But this part I think is so fascinating. When Bear Stearns, in March of 2008, Bear Stearns dies. They're married off at a discount, a ridiculous discount that was later revised slightly, but they're married off to J.P. Morgan Chase. And just as we've been talking about, all their counterparties, the creditors, lenders, and others, were taken care of by J.P. Morgan Chase, and they were protected from any of the harm. The stockholders saw their investment go from 170, I think, 172 in January of 2007 to 2. It ended up, selling at 10,
right?
But that was very close to zero, and a lot of people lost a lot of paper profits on that. But that was March. September is 6 months later. In between March and September, two things happened that are unbelievable. I don't think have gotten enough attention. One is that Lehman becomes more leveraged. Lehman, whose books look a lot like Bear Stearns, who have very similar assets, is somehow able to continue borrowing money, which to me suggests strongly that people thought that they would be taken care of in the event of a Bear Stearns crisis. The more dramatic example, though, is the money market fund, Reserve Primary, I think that's the right order of the words, which is the first money market fund, lends Lehman an enormous amount of money, hundreds of millions of dollars during this period, and is holding that piece of paper. And then when Lehman goes bankrupt, the money market fund does the so-called breaking of the buck. They have to lower their asset value from $1 to 97 cents, and that sends tremendous shockwaves through the financial world that even money market funds now maybe have taken on too much risk. But why would they do that? And the answer is they were making it. And I learned this fact from Arnold Kling and later a story by James Stewart recently in The New Yorker. Why would they do that? And of course, the answer is partly, well, they figured there was a decent chance they'd get bailed out when Lehman did go bankrupt.
Yeah, it's interesting. You bring up that case because I remember back in a friend of mine was running a money market fund back in the Continental Illinois days, and so that was before. This was before Continental was bailed out. But everybody knew Continental was shaky, and he was buying Continental certificates of deposit for his money market fund,
making his fund look really good that quarter.
Well, and I asked him what he was doing, and you referred earlier to the fact that a lot of this is a probability game because you don't know the future for certainty. And what he told me was, well, he was willing to buy 1 month or 2 month CDs because not because he was counting on a bailout, but because he said to himself, Continental may fail, but not in the next month or two.
Probably.
And I think in his case it worked out because Continental creditors were bailed out. But it was an interesting window into how investors think about some of these things. And even if you think the institution is of poor quality and may not last, you have a timing dimension as well. And you may say to yourself, is something really terrible going to happen in the next 30 days? And if you answer that question no, you might be willing to buy the paper.
Yeah, that's very important because, of course, even in the case of Bear Stearns, the plug gets pulled on them when lenders finally in the overnight repo market, the repurchase market, say no more. And you have to ask then, well, why didn't they just say, well, the government's going to bail us out? Why did they finally say no more? What's your answer to that?
Well, I think the answer to that was they did a risk reward calculation, either explicitly or in the back of their heads, and said, maybe the government's going to bail them out, but I just don't want to be there to find out.
A little uncertainty there, right? Yeah. Let's, but before we get to the solutions to this problem or what we might hope would make it better, I want you to talk about something you mention in your book in passing in a few places, which is the reaction of people when you put this hypothesis forward. Because I've also had, now that I'm a convert, I'm having the same issue, and I start to suggest that this history and empirical evidence on bailouts suggests that there's a moral hazard problem. They say, but you're crazy. Equity holders still have a risk, and they're not going to let the firm do this, that, and the other. And so when you've presented your work, and you've talked about this widely in many audiences in many places, you get a lot of pushback. You get skepticism. Talk about that. And also, I assume practitioners don't like to hear it either.
Well, I think there's, you do get a lot of pushback, although less, quite honestly, less now than we did when the book first came out.
You're looking a lot smarter.
And I think it takes several forms. One I mentioned earlier, there were until recently people who believed that fiducia effectively addressed the problem, that we were just wrong, that the issue had been addressed and was much ado about nothing. I think as history has demonstrated, we were in fact right. I would have, in a way, preferred not to have been vindicated, but there we are. Yeah. I think there are people who believe that it's just not good public policy to impose losses on creditors of systemically important institutions. And while I can't quite get my arms around what underlies that view, I think at a more superficial level you can understand it. They simply must feel that it's potentially too disruptive to do that, and so you've got to find alternatives. A third thing that we hear and have heard is that the best thing to do is to make supervision and regulation sufficiently effective that you can prevent these episodes going forward. And in my experience in this environment, and given the incentives that we confront, that's just not possible. I mean, we should make supervision and regulation as effective as it can be, without squandering resources, of course. But we should not kid ourselves that supervision and regulation by itself is capable of dealing with the too big to fail problem, because I think the track record suggests it's just not.
Yeah, it's not a lot of evidence that it's
right.
At this time,
I mean, that's a wish, and we'd all like effective supervision, but it's not going to be sufficient.
Well, one of the reasons, and again, I've learned this from Arnold Kling, his recent paper. I'll put a link up to it on the crisis. Has some of this in there that you think you've stiffened, say, capital requirements,
right?
And therefore, you've made a cushion now that there's going to be fewer systemic losses in the case of a bankruptcy. But those regulations tend to be flexible. There's a political dynamic that's often ignored. It's like when economists, and I can't believe they still do this, but they say, well, we have to reconstitute Fannie and Freddie because they're crucial for liquidity. So we got to recreate them. But this time, it's going to be different. This time, we'll just have different regulatory strictures so they won't get out of control. Well, yeah, we had that before.
Right? No, I agree with you on that. I don't have the solution as what we ought to do with Fannie and Freddie, but I agree that sort of somehow believing that you're going to preserve the incentives but have better supervision and therefore have a better outcome, I think is kidding yourself.
Yeah. So let's turn to the solutions to Too Big to Fail itself. You talk about a lot of them in the book. Some of them are, I think, a little more convincing than others. Why don't you lay out, and you're honest about the riskiness of some of these solutions. Talk about what we might do to encourage more prudence and restraint on the part of creditors than we have now.
Well, you started at exactly the right spot from my point of view, Russ, and that is we've got to find a way to credibly, and I would emphasize the word credible, you've got to find a way to credibly put creditors of these systemically important institutions at risk of loss. You can't simply say you are now, going forward, we're not going to bail you out. That's not a credible statement. You have to take actions so that they understand the regime or the environment or whatever word you want to use has changed, and that indeed there's a much higher probability, it's not going to be 100%, but there's a much higher probability going forward that they will lose money if one of these institutions gets into difficulty than was the case in the past. And earlier I talked a little bit about preparation. And preparation, I do believe, is very important. And let me just describe what I have in mind there. As I indicated, the reason policymakers intervene in these cases, in my judgment, is because of concern about spillovers that would have adverse consequences for other institutions and major financial markets and ultimately for the economy itself. So preparation means identifying and then taking steps to limit those spillover effects. And that's an analytical question, but it's something that can be done. A lot of that information is already available. You look at where do these large institutions have major exposures, in which markets, to which counterparties, and so forth. And you also can ask yourself, are those exposures prudent? In some cases, you may decide that indeed the institution is very large, but because of the nature of its business and the nature of exposure, it doesn't pose any systemic risks, and then you don't have to do anything. And then if it fails, you're confident that you can impose losses on creditors because you've prepared, you've done the analysis, and you have satisfied yourself that the spillovers are manageable. In cases where you're concerned, you're going to have to use authority to get them to reduce those exposures. You don't want to reduce to zero because you can't have a financial world where nobody trades with each other or has exposures to each other or positions assets or anything like that. But that doesn't mean in some cases they shouldn't be smaller or backed by more capital than they currently are. But that's a great emphasis on preparation, and it's work that should be done in tranquil, sound times in financial markets, because in the middle of a crisis, you're dealing with the crisis. You're not trying to understand the prospective nature of exposures that might bring on the problem.
Let me ask you about two problems with that.
Yes.
Did you want to say something else?
No. That covered that.
What I worry about in that, that's appealing, and it's always good to add transparency. It seems to me. The worry I have is that one, if you have a policy that says if we think you're not too systemically connected, we're going to let the chips fall where they may.
Right.
That's going to create an incentive for people to be more connected. Some people have claimed, I don't think it's true, but some people have claimed that Lehman's big mistake is they weren't interconnected enough. They blew it. They should have been taking riskier bets with more people. But certainly if it became known and it was a credible promise that we were going to be more we're going to make some suffering take place, then you'd have an incentive to be more...
I take your point, but that's where the other side of my suggestion is important, that where institutions... this has to be ongoing work, so it's not once a year you look at these organizations or something like that, but where you see exposures that you consider to be excessive relative to either the capital or the management ability, then the authorities have to be prepared to intervene and to say, you've got to reduce those.
That raises my second question: is how do you keep that from being an ad hoc process that is prone to rent seeking and other problems? So, one of the claims, which I always find strange to solve the problem, is, we won't let institutions get too big. But that's a nice statement. Implementing that in a policy world is really fraught with uncertainty. What would you make them sell stuff? What stuff? How would you decide? How would you measure it? So I'd worry that in the case where if I've got an ongoing monitoring process and I'm, as say, the chair, whether it's the head of the Fed or whether it's Treasury or some independent new organization that gets set up,
right,
I'm going to be intervening in relationships between financial institutions on an ongoing basis. It's not really as much of a market process as it would seem to be. Isn't that going to lead to some...
You're quite right that there's always devils in the details. And I think until this kind of proposal is implemented, we won't know in advance where all of its strengths and all of its shortcomings are. So I certainly agree with that. On the other hand, let me point out that just because there may be some, say, supervisory discretion here doesn't mean that policy is random. And my guess is that if policy is these kinds of things are implemented in a consistent way, one of the virtues will be that the financial institutions of concern will understand what the what the rules the policymakers are using, whether they're explicit or implicit, what rules policymakers are using, and will come to adjust and perhaps adjust pretty quickly. In any event, I don't. While this proposal has the weakness of not having been tried, so we can't say for sure it's going to work. The things that have been tried haven't worked, and so it seems to me that before we dismiss it, we ought to try it.
Yeah, well, it might be better than what we've got. Let me ask you about your first point, which I just find it interesting. Both politically and psychologically, the idea that we ought to put in positions of authority people who could, at least either by their past reputation, by the statements they'd made at their hearings, I think you talk about at least that they were plausibly people who might not bail out large institutions. Right. So let me play. Let's have a little imaginative session here. Suppose that Gary Stern was made the head of this new body that's in charge of systemic risk.
Right.
You're a pretty credible guy. You've written a book about the dangers of too big to fail. You've appeared on EconTalk where you talked about all the destructive aspects of it. You've got a reputation.
Right.
Is it imaginable that in that situation you would keep your reputation as opposed to bow to the political pressure to bail out those creditors?
Well, the short answer to that is yes, but the longer answer is that's why preparation is so important. And let me just try to highlight that
go ahead.
Again. I mean, I don't think you can ask me or anybody else if a financial crisis comes out of the blue and you haven't done the preparation. I don't think you can ask any policymaker to let some large institution go so that you can teach the creditors a lesson. Because that may not pass a cost-benefit test.
It's too late.
The cost may be too large for the economy relative to the lesson taught to the creditors. But that's exactly why preparation is so important. If the guy who gets to make this decision is sitting there, and he knows because that they have acted to limit spillover effects earlier, then you don't have so much trouble making the decision to not protect creditors. And the reason you don't is because the costs are much reduced. And so that's what's so critical here, in my judgment, about preparation. If you can get those costs down, then the benefit-cost equation looks much better. And indeed, if you communicate to the creditors in advance the nature of your preparation and the reason behind it and so on and so forth, you'll get better pricing of risk-taking in the marketplace, which will make these events less likely, not zero, but less likely going forward. So it has the potential, in my judgment, to set up a virtuous circle if you communicate what you're all about as well. And I think that's important.
Do you get any traction for that idea? Are people listening to that and considering it seriously?
Not as much traction. The answer is not as much traction as I would hope. And I don't know the reason. I don't know the reason for that. Obviously, there are a variety of different proposals around, and we've modified our proposal some over time as well. And by the way, some of what is being proposed does make perfectly good sense. Higher capital requirements, perhaps higher insurance premiums, perhaps
it's not the worst ideas in the world.
Greater holdings of liquid assets for systemically important institutions and so forth. Those all would be helpful, although by themselves they don't get to the moral hazard problem.
Yeah, my whether it's my cynical side or my realistic side, whatever you want to call it, for me, the politics are such that this too big to fail policy is a way to not occasionally, on an ongoing basis, basically reward some very politically powerful people. And I'm not asking you to respond to that, but what has in fact happened, and this is I think should not be forgotten, what has in fact happened over the last 15 months is that the average American has sent hundreds of billions of dollars to some of the richest people on the face of the earth. And that, to me, is, I think the more people understand it, the better the chance that the political incentives will change. If people don't understand it, the political incentives are going to stay in place. We're almost out of time. I want to ask you two questions. One a very a naive one, and one a bit challenging. The naive question is this: if Bear Stearns had failed, or if we had done nothing in the face of Lehman's failure, the failure of Lehman, some say, prompted an enormous response because of the spiking of interest rates. What if we had done nothing? What if, obviously there's, personal costs that have political influence, but, this worry that credit markets would freeze up, what would have been the real side? Do you have a feel for what the real economy implications of that would be? What were people worried about and talking about that at least justified? I've been appalled at how unjustified in the communication sense these interventions were. What do you think the best case you can make for those interventions?
Yeah, well, we of course don't have what we economists like to call the counterfactual. So it is pretty speculative, and speaking for myself, of course, I don't know how bad things would have gotten in the financial markets or in the economy itself had Bear Stearns been let to fail, or had Lehman Brothers been handled in a different way. My own view of that is, difficult as it is to say it, I'm glad we didn't find out. I do think the consequences would have been exceedingly severe. I can't quantify them. I would be willing to place at least a small bet that if we were having this conversation today, but in the wake of a different decision, we would be looking at a much weaker economy with much more dire prospects than we are right now. Now, I could be wrong, and I'm not one who typically underrates the resilience and flexibility of the markets or of the economy. But on the other hand, history gives one pause about inadequate responses to major financial disruptions. Yeah. And so I think you got to be careful.
Yeah, well said. Last question. It's multi-part, so it's a little tricky. The Federal Reserve balance sheet right now has something between $600 and $800 billion of mortgage-backed securities that had been issued by Fannie and Freddie. They've been pouring money into Fannie and Freddie. They did two things, really. They bought up some old ones, and they've been then buying new ones as Fannie and Freddie have issued those. What they're essentially doing is channeling money into mortgage markets to keep interest rates on loans low so that the housing market doesn't – I assume the logic is that this way there won't be a reduction and further reduction. It's trying to keep the price of housing supported so there won't be a further default on existing loans. Two thoughts on this. One is they're not mark to market, strangely enough. They're probably not quite worth what the Fed says they are, that they have them on their books. That's number one. And number two, what do you think the implications are for inflation as things return to normalcy and the cash that's been pumped into the economy via those interventions starts working?
Okay. Well, as far as the first issue is concerned, the purchase of substantial volumes of mortgage-backed securities, as well as some direct agency debt and, of course, Treasury debt. I mean, I think the way I think about that is I think what really is dominant there is the macro objective. And all I mean by that is, the economy entered a recession at the end of 2007. The recession lasted probably until a couple of months ago. It was broad and deep and far-reaching by many metrics, and I think you would expect, and in fact it had, that a central bank would react significantly to that environment and to the prospects before it. And when short-term interest rates hit zero, then obviously you had to look for other ways to have a macro effect, and these were the logical places to look. Not so much in my judgment because of concern about housing, although there certainly is that concern, but you want to try to operate in relatively broad, deep markets, and also not get into the business of buying corporate credits or something like that, where then you wind up picking and choosing among quality and so on and so forth, which is really a can of worms. With regard to the balance sheet and inflation, I think that issue is exaggerated in the following sense. Two senses. One is, while there's a very strong relationship between money and inflation in the long run, you have to emphasize long run, which is periods of 5 and more likely 10 years, and if you go look at the evidence, and there's actually quite a bit of evidence. So what happens to the balance sheet for a period of a year or two is not going to be decisive unless it persists. And that gets to the second point, which is, the Federal Reserve, and indeed all central banks, always have a challenge in terms of making decisions about when to become less accommodative or when to start tightening, or however you want to put it, and by how much. And that's a challenge after any recession and any period of substantial accommodation or ease. I don't jump to the conclusion that the Federal Reserve or other central banks are necessarily going to get it wrong this time. Indeed, if you look at the inflation performance of certainly the U.S. economy, but much of the global economy since the early 1980s, it's been a period of diminishing and ultimately relatively low inflation or stable prices for quite some period of time. So I think the nature of the challenge is similar to the challenges that are always faced. And, while I can't guarantee that the Federal Reserve and other central banks will get it right, I think history gives you at least some modicum of confidence that they may.
Well, on that cheerful note, let's end. My guest today has been Gary Stern, author with Ron Feldman of the book we've been discussing, Too Big to Fail. Gary, thanks for being part of EconTalk.
Good to talk with you, Russ.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.